Let's be honest for a second. Funds feel tight right now, everything costs more, and figuring out how to make extra money can feel overwhelming. Maybe you've always liked the idea of owning an investment property, but you've assumed it's off the table because you don't have 10, 15, or 20% saved for a down payment. Here's the part many homeowners don't realize. You might already be closer than you think. Home equity is the difference between what your home is worth today and what you still owe on the loan. If you've owned your home for years, let's just say a few years, there's a good chance you've built equity without even trying. That equity isn't money sitting in your bank account, but it can be used as a tool. Many people believe the only way to buy an investment property is by saving a massive down payment. But one option is to let your existing home help fund the next one. So let's walk through how that actually works. Option 1, use your equity, move, and turn your current home into a rental. This is one of the most common strategies for first-time rental owners. There are a few common ways homeowners access equity, and while the specifics vary, the process usually looks like this. This is typically done through a cash-out refinance or a home equity loan or line of credit. A lender will review your current mortgage, your credit, and your income. The lender orders an appraisal to determine your home's current market value. This step confirms how much equity is available and how much can safely be accessed. Once approved, the equity is converted into usable funds, and those funds are typically used towards purchasing your next home. At this point, your current mortgage structure may change depending on the option used, which is why planning matters. You move into the new home as your primary residence. Your original home doesn't get sold, it gets repurposed. Once you move out, your current home can be rented out. Rented income can help cover the mortgage, taxes and insurance, and ongoing maintenance. Over time, tenants help pay down your loan while the property continues to appreciate. The first home goes from sentimental to strategic. Rentals are powerful, but they're not passive. Homeowners should plan for maintenance and repairs and replacements, vacancy periods, and whether to self-manage or hire a property manager. The goal isn't perfection, it's preparation. So now let's talk about another option many homeowners have never even heard of. DSCR stands for Debt Service Coverage Ratio. This loan focuses more on the property's ability to pay for itself and less on your personal income. So instead of asking, does your income qualify for this loan? The lender asks, does the rental income cover the mortgage payment? If the rent supports the loan, the property helps qualify itself. Personal income documentation may be reduced, and the loan is tied to the investment property, not your primary home. This can be especially helpful for those that are self-employed, commission-based earners, or those wanting more flexibility. This strategy only works when the numbers make sense. Rental income, loan terms, interest rates, and cash reserves all matter. This isn't about stretching yourself thin. It's about moving forward with intention. If you've ever thought, I want an investment property, but I don't have the down payment, your home equity might already be doing the heavy lifting for you. Wealth building doesn't always require more money. Sometimes it requires better understanding. If you're curious as to whether this strategy could work for you, even if it's just a conversation, I'm always happy to help walk you through the numbers and options so that you can decide what makes sense for your goals. Because clarity creates confidence, and confidence creates opportunity.